people who don't fully understand all of the numbers, I'm going to give you a very easy example to understand how things would have prevailed if you had $10,000 invested back before the Great Depression. So with the Great Depression, there was a market crash of 86%. If you had $10,000 invested at that time, that $10,000 would now be worth about $1,400. Now, of course, in the 5 years after the Great Depression, the market actually increased by 265%. Now, 265% in a 5-year period actually averages out to about 29.55% per year. And the way that we calculate that is using this formula right here. It's a very simple formula for us to figure out what the annual rate of return is. Now, 29.55% per year over 5 years, when your investments are at $1,400, will only get you to about $6,000 or so when the markets actually jump back up. So the idea here isn't to say that your investments are going to be significantly higher than where they were before. It just means that things have bounced back, not quite to the levels where they were before. So the markets didn't actually fully recover for another 30 years or so. Now, the one reason though that I'm presenting this information is because I want you guys to see that if you just stick with your plan of investing, then you guys will actually end up further ahead in the future than where you would be if you just stopped investing. Now, let's say, for example, you had a plan of investing $100 a month, and you continue to invest $100 a month even when the market declined. One thing that you can see is with that 265% increase, or that 29.55% annualized return over those 5 years, if you continued investing in that time, you would put in an additional $6,000. So now you've had $10,000 from before the market crashed and an additional $6,000 over a 5-year period that you invested. And if you actually take a look and see what happens with the investments at that time, then your overall portfolio would be over $19,000 as you continue to invest $100 a month. This isn't to say that you would have more money by just leaving the money in the investments. You have to continue putting more money into your investments so then you can really take advantage of those market declines and of course the market gains that come after those big crashes. So in this case, you can see if you didn't put any additional money, your investments would be at about $6,000. By putting in an additional $6,000 or $100 a month, 5 years, now you have over $19,000, which actually puts you over the total amount that you invested. You'd have an additional over $3,000 more with the gains from the markets at that time.